Hey everyone, welcome back to Coyote Loot Crate, where I discuss all things gold and silver. This week is an update on the gold and silver price, the recent discussions in the news, and again, my personal opinions on where things are headed. I will leave links for the sources that I use in this video for anyone to read in their own time. I try to use a balanced approach when it comes to source material, so hopefully that is reflected in my videos. Furthermore, I'm not sponsored or endorsed by any of the sources I share or refer to on this channel. So without further ado, let's fire on. So first things first, let's have a wee look at what's going on with the price over the last week. So we'll begin with gold, and just going off the UK pricings to begin with, gold had a turn down of about 20 quid this week. So it had a low of about £1,308, but it managed to at some point get up to 1343, which I think was around the 11th. Yeah, that's right. But the 11th, it got over the 1340 mark. So yeah, it's similar to the last week where, gold was on a trajectory of going down to about 2%. As you can see, it's about 1.52 that it fell to. And then if we look at the US comparison, it was down $35. So yeah, it had a week low of about 1,845. And it managed to, in the same day, obviously as a comparison, it was 1,900 it got up to. And with regards to silver, again starting from the UK, silver actually had a turn up of 14 pence. It had a high of exactly £20 and a low of 1948. And again happening on the same day as gold had its highest peak, which was the 11th. And so obviously we can assume that by looking at the US chart, yeah, same day, and I've still got the highlighted for the silver price on the Sunday, but that was a similar approach with 12 cents turnaround. So yeah, compared to last week, silver did a little bit better, and we're kind of waiting to see whether or not it's going to break that $28 bracket and continue on its way up. And so turning to the news on gold and silver this week, we'll begin with the US viewpoint, and the source is Money Week, who reported that gold had quietly done pretty well, and it was coming off a textbook W bottom in March at $1,675 per ounce, and had marched over the $200 mark that was higher through April and May and reached $1,920 yesterday, where it has inevitably stumbled. So why do they say inevitably? Well, it's because $1,920 was the price it reached in 2011 after 10 years of bull market, which you can see here in this chart. And it was one of the, as they quote, epic bull markets in gold's history. And it certainly was when you really look at it. That's a considerable rise. And then obviously gold dropped at that point, and it's come back around and continued on its way up at this moment. And, it's held that high for 9 years until it was eventually, though only briefly, overcome last year, where we had it reach over $2,000. And additionally, silver was reported to be doing pretty well, as we've seen for ourselves. It stayed positive this last week. And although currently at $28 an ounce, if it can get above the $30 mark, there's a high chance it can then head towards its $50 new all-time high. They go on to mention that the recent investment trends can be described as great rotation from tech to physical or some such, essentially showing the cycle of paper assets to physical assets like gold and silver. But that the main concern was surrounding the US dollar, which is still, as they put, the single most important price in the world, which it really is at the moment. It's what everything else is tied to as the fiat currency, the main one in the world. The US dollar index, however, had peaked at 103 prior to the corona panic in March 2020, and this hadn't been seen since 2017 at the turnover from Obama to Trump. And so, yeah, we've had this huge multi-year double dip, like an M shape. And since then, it's been in free fall, and 2020 ended at 89. So, yeah, they arguably are looking to see whether or not, as you can see in this chart, whether or not the US dollar index is going to test the 88 and 89 benchmark. And if it is to continue on a downwards trajectory, then silver will potentially be very bullish as the price of the dollar continues to drop, and in tandem with inflation, you'll have that hedge from the precious metals. Kyle Bass from Heyman Capital Management was reported as saying this week that the actual inflation number was 12% and not the given 5%. He noted that the Federal Reserve's easy money policy had added 34% more money to the system in the last 14 months, which obviously cuts consumers' buying power. That's an annual loss of 12%, which is just ridiculous. He advised to move out of cash ahead of inflation, and also noted that stocks would be able to keep up with 85% of the inflation figures, so investors won't lose too much there. But he did stress that in order for this to happen, stocks would need to have a mid-teen score against inflation. Compared to 2020, PPI is up 6.6%, which is the largest increase since November 2010, when the 12-month data was actually calculated. And turning our attention to goldseek.com, who reported that CPI came in at 5%, which is the highest in over a decade. Core CPI being 3.8%. Core CPI was up 3.8%, which is the highest in 30 years. As you can see here, you've got pre-1995, it was, just above the 5%, and then we're seeing it again happening in 2021. But this is based off the noted price from last year, where, in 2020, we had the CPI just above 1%. And so now that it's reaching up to levels above 4%, you're seeing that increase. It's considerable. Moreover on that, car prices are up as there's obviously the semiconductor chip shortage. It's getting worse. There's so much demand and the supply is just not there. Supply for new vehicles as well as used, among other commodities, are struggling. I believe used vehicles are up to 48% in price since 2020, and pickups alone are up 70%. It is predicted by some that the shortage could last another 2 years. The Fed, they're calling it transitory to lower the fears and calm the markets, but time will only tell whether this is accurate or not. So turning our attention to the UK, the main headlines this week were that the UK inflation had gone over the Bank of England's target of 2%, reaching 2.1, and this is only June. So the Bank of England has predicted that the inflation this year will cap at 2.5% to only fall back down. But the way things are going, it could be a lot higher. Is an acceleration of April's 1.5% as the economy is obviously unraveling from the tight lockdown restrictions, and we're obviously seeing the spenders are out, money's being flown about to get people out and dining and shopping and all that sort of stuff. The summer will obviously see a significant increase with schools finishing up and families wanting to get away and maybe try and get like a domestic holiday somewhere, potentially over international, but we obviously have to wait and see how that plays out, considering as well that Prime Minister Boris Johnson has delayed all restrictions being lifted by another month. So it's not a concern really that the inflation in the UK is going to be anything of a hindrance. Considering if you compare it to the US with its apparent 12%, but sort of mainstream 5%, and the 6 trillion stimulus that Biden does want to inject or will inject into the money system. So we're still predicted to be the 2.5. British house prices in April were up 8.9% higher than in 2020, according to the Office of National Statistics. London alone was 3.3% higher in April, and this has been one of the largest rises that they've seen since 2007. And I think finally, I want to bring attention to the fact that as much as America is suffering from it, the UK is definitely starting to feel the burn of the supply issues of labour materials, especially within the construction sector. Again, reading from The Guardian, only a quarter of materials used by the construction industry are imported, but price increases in some areas are substantial. It was noted that timber had gone up by more than 80% in the past 6 months. Copper and steel had jumped 40%. And the cost of paints, varnishes were up nearly a third, while your polymers, your plastics had risen by 60%. And at the same time, they're also struggling to find the workforce. The labour force itself there is really small. They're needing to get prices done. In some cases where they've had jobs booked in advance, they've had to return to customers to say, look, you're going to have to pay a bit more. Obviously, this is a housing boom that we are in, which, again, if I had to bet any sort of money on it, that it is going to drop, that it's going to happen anytime soon. There's a high likelihood. There's a high likelihood that the price of houses, there would be a small crash coming our way in the next 3 to 4 years. So yeah, that's kind of the outlook of what's happened over the last week. I definitely want to keep my eye on how things play out with regards to supply and demand, and whether or not there's going to be an even higher increase in inflation within the UK, whether the Bank of England were being very conservative about their targets. And I also have another video coming out this week where I'll be doing an unboxing of my recent purchases, so I'm very excited to show you guys that. But that's enough from me today. If you guys like the content, please leave a comment and a like below to let me know if there's anything you want me to cover. And yeah, as always, thanks very much for watching, and I look forward to seeing you in the next video. Cheers!